Good morning, everyone, and welcome to our webinar this morning under that Understand and Plan Your Personal Income Tax Finalization in Vietnam. I see it's 10 o'clock already. We're going to be ready to start in a few minutes. Let's wait for our attendees to join. And then we'll have Betty and Fung to share their interesting insights on planning the personal income tax in Vietnam. My name is Vlad Savin, Head of Business Development of Preplanning Vietnam, and I will be your host and moderator for today. And we'll start first with a quick session, with a quick introduction on who we are, a few details about Preplanning Vietnam. We're a corporate service provider. We are focused on supporting international investors with our market entry, company setup, and company structures in around 10 jurisdictions across Asia. We do accounting, taxation, tax advice, regional compliance, and things related to payroll outsourcing as well. So we cover a full corporate service background for investors active in Vietnam. And as well, we focus on advisory services. These are our offices here. We're actually opening a new office in Philippines very soon. We're present in Cambodia, China, Indonesia, Malaysia, Thailand, Vietnam, Australia, and Singapore. Few details on how you can interact with myself and the panelists. You have the Q&A function, which is commonly the easiest way to put down your question. We will get to them at the end of the discussion one by one, and hopefully we can answer all of your questions. You can use the chat function as well where needed, or potentially you can also raise your hand and you can turn on your microphone to have an interactive discussion with the panelists and myself. This is pretty straightforward. I'm sure all of you are familiar with the Zoom until now. I see already we have quite a lot of people logged in. Okay, let's see, what are we talking about today, and 5 things that could be important from this presentation. First one would be an overview of the personal income tax finalization in Vietnam and how that works. You will understand and learn about guidance on data preparation and how it works in practice. Our colleagues will outline and clarify the forms required to be prepared and submitted. They will talk about taxable benefits in kind, and in the end, they will focus on practical insights and potential issues with personal income tax finalization. Okay, let's go back for one more minute. And then I'll do the introduction with the speaker, so then we can slowly start the presentation. I see everyone is slowly logging in. Good morning for the late arrivals. We're going to start in 1 minute our presentation on planning and understanding personal income tax in Vietnam. This webinar is recorded as well. We'll ensure that we'll post it by the end of the week, if not Monday next week, on our YouTube channel. We'll share it across by email as well with all the attendees. So you're going to have a full recording of this webinar as well. All right, I think we're ready to introduce our first speaker, Fung, or Tracy for some of our clients that know her already. She's the head of HR payroll consultation for a client in Vietnam. She has over 15 years working experience in payroll management and HR. She holds a bachelor degree of business administration and from the Telecommunications Institute of Technology. And she's fully experienced with working with international investors, as I mentioned before, and supporting them with their payroll and HR matters. So without further ado, I'd like to stop the screen sharing and introduce Tracy to turn on your camera, your audio, and please share your presentation with the guests. Hi, Tracy, we can see you well.
Yes.
Good morning.
Good morning, Flash. Good morning, everyone. So let me share my screen first. So you can see my screen, right, Flash?
Yes, we can see it.
Yep. Okay. Hello, everyone. Good morning. My name is Phương, or call me JC. Today, Betty and I will talk about annual personal income tax finalization for individual in Vietnam. Like other countries, Vietnamese personal income tax is also a factor that everyone working or investing in Vietnam has to pay attention to. Now we will go through an overview of individual annual personal income tax finalization in Vietnam, guidance on data preparation procedures, and we can see what can Aklam assist you on this matter. Firstly, we should understand how tax residency status impact to income subject to tax declaration in Vietnam. There's definition of tax residence and tax non-residence in Vietnam. Tax residence as a person reside in Vietnam for 183 days or more in a calendar year or in 12 consecutive months from the first day of arrival to Vietnam, or they are Vietnamese nationality, or he is hold a temporary or permanent resident card for Vietnam, or they lease a property for a term of 183 days or more in Vietnam. So those tax residents in Vietnam will have to declare the work while employment income, and they may have to conduct the annual personal income tax finalization in Vietnam where required. The tax non-residents, a person is a tax non-resident in Vietnam if they don't meet any condition of a tax resident, and they just have to declare the Vietnam source income only at a flat tax rate of 20%. For example, a CEO in Singapore, he's still working and living in Singapore but managing a rep office in Vietnam. He's also being a chief rep of the rep office and receive a portion of salary for that job. So that portion of salary we have to declare for the tax in Vietnam at a tax rate of 20%. But he doesn't need to do the annual personal income tax finalization at the end of the year in Vietnam. So who we need to conduct the PET finalization? The first group are those are not required to make the annual finalization. An individual is not required to make annual personal income tax finalization if he has an additional PAT payable less than 50,000 Vietnam dong upon finalization, or he has an overpaid tax but he doesn't wish to refund, or he has an irregular income not exceeding monthly 10 million Vietnam dong and 10% personal income tax was withheld. He may choose not to include this income in the tax finalization at the end of the year. So he may authorize to his current company to do the PAT finalization for himself. The second group, those people can authorize to their current company to do the finalization for themselves. and they may receive a notification from the company for the conditions in detail. The third group are those who are subject to lodge a direct annual personal income tax finalization with the tax office directly. So who are they? We may define in four groups, four cases. The first case are those has two or more sources of income in the year, and they have to pay additional personal income tax upon finalization, which is more than 50,000 Vietnam dong. So they have to submit a direct tax finalization with the tax office. The second case is an expat. He's in the first day in Vietnam and stay less than 183 days in calendar year, but he will be staying more than 183 days in 12 months from the first day of arrival to Vietnam. The third case are a foreigner who has a labor contract terminated and he's leaving Vietnam. So he needs to do the tax finalization before leaving. The fourth case are those having tax reduction due to disaster, fatal disease, accident, fire. So they seek a tax relief. So they have to submit an annual tax finalization with the tax office directly. Deadline to submit the tax finalization report and the tax payment. From this year, 2021, the deadline for an individual taxpayer to file the finalization and make the tax payment is the last day of the fourth month from the end of the calendar year. It means 30th of April. This is the due date. In the case that the foreigner who will be terminating the labor contract and leaving Vietnam, he will have to do the self-finalization before his departure. In case his is not completed before the departure, he may authorize to a company or person, individual, to do the finalization for himself within 45 days from his leaving date. So the authorized company or the authorized individual will be fully responsible for the tax refund or the tax payable of the foreigner. Now we have some scenarios on how to define the annual tax finalization liability, due date of finalization report submission in the first year and the second year. The first case, there's a Mr. Henry who was from Singapore. He arrived Vietnam on the 1st December 2020 in the first time to work as production manager for company A. He stayed in Vietnam totally until now and still employed by company only. So he is a tax non-resident in 2020, but he will be a tax resident from his first day of arrival to Vietnam from 1st December 2020 to 30 November 2021. So his first tax year is 12 months from his first day of arrival. It means from 1st December 2020 to 30 November 2021. And the due date for his submission of the tax finalization in the first year is 4 months later from the end of the tax year, which is 30 of March 2022. His second tax year is the calendar year of 2021, and due date of the tax submission is 30 April 2022. The second case, another Mr. Henry who was also from Singapore. He arrived Vietnam also from 1st December 2020. It's also the first time, and he stayed until end of May 2021. Then he he left Vietnam on the 1st of June 2021 to be back his country as the company is closing down resulting from COVID-19. So he's a tax non-resident in 2020, but he's a tax resident from the 1st December 2020 until 31st of May 2021. And he will have to submit the tax finalization before leaving Vietnam, or he will have to submit the tax finalization within 45 days from his departure day, which is 15 July 2021. The third case, this case we also call Mr. Henry, who was also from Singapore, arrived Vietnam on 1st January on 2021. He will be under a short-term assignment of 18 months. In the first quarter of 2021, he received a yearly bonus from his previous company in Singapore. He plans to leave Vietnam on 1st of April 2022 for a personal reason. So in this year in 2021, he is a tax resident, and his first tax year for finalization is 2021 from the 1st January to 31st of December 2021. And he needs to submit the tax finalization before 30th of April 2022, which is 4 months later from the end of the tax year. In 2021, he received 2 sources of income, so he will have to do a self-PAT finalization. In the second year, 2022, he will be a tax non-resident, so he doesn't need to submit the tax finalization before his departure. It's not required for a tax non-resident. So you may understand on how to the tax resident status impact to the tax year and the due date of the tax finalization, submission, and the tax payment. Now we are looking to the data to be prepared or documents to as a supporting document for the tax finalization in Vietnam. For Vietnam income sources, the taxpayer will have to collect the letters of annual income confirmation, certificates of withholding income tax from the employers. Tax dependent. The taxpayer can register children, mother, father, or spouse, or grandmother, grandfather as a tax dependent for a relief of 4.4 million Vietnam dong per person per month. In general, in case the relatives are below or above working age, the condition is that they don't have any income during the year, or their monthly average income is not more than 1 million Vietnam dong per month. In case the relatives are at the working age, an additional condition is that the dependent is a disabled person. In some cases, there will be certain conditions. Due date to register tax dependent is 31st of March of the following year for children parents, and it's the 31st of December for other relatives, such as grandmother, grandfather, auntie, uncle, or brother, sister. So the registration has to be done properly and successfully. If failed or unqualified, the dependent's relief will not be taken for the tax finalization. It may result to additional tax payment or penalty if filed later than the due date of tax payment. Service contract the individual taxpayer should have to relook if they have any service contract during the year. In case the total income of those service contracts is more than 120 million Vietnam dong, and the PT 10% was not withheld, they have to include this income in the tax finalization. Overseas tax payment and statutory insurance. In case the taxpayer has short payment with a proof or confirmation letter from the company or the authority overseas, this can be taken into account for the tax relief or the tax credit against the tax payment in Vietnam. Non-taxable benefit. Taxpayers should be aware of such non-taxable benefits, such as one round-trip airfare for returning home leave, school fee for children up to high school, one-off relocation allowance for foreigners coming to Vietnam, or Vietnamese working abroad, house rental and utility expense, which above 15% of taxable income is non-taxable. What happened in case of late submission or late tax payment? The interest for late PAT payments is only 0.03% per day, but the penalty of late submission of tax report is up to 25 million Vietnam dong for more than 90 days. So in any case, the taxpayer is subject to the tax finalization. The person should submit the finalization return before the due date, even if it's a wrong data or just a blank form, to ensure there's no penalty of the late submission. In case the taxpayer has a tax refund or offset the overtax payment in the following year, there's no penalty. So it's not rushed for them to submit the tax finalization before the due date. We continue with the procedure of the tax finalization for the individual in Vietnam. Vietnam is applying technology and digital transformation in government management. However, there are still paper procedures for tax finalization for individual in Vietnam. Firstly, the taxpayer have to submit their tax finalization declaration on the tax website. This is the three tax website: thuế.gdt.gov.vn. They can declare directly on the e-portal of the tax department. In the second step, they have to submit a physical submission of tax report signed with the signature to the tax office. The e-portal of the tax department can assist the taxpayer in identifying the tax office for online submission and physical submission. For any additional tax payment, the tax payment can be made via internet banking or mobile banking, but the detailed payment needs to be input carefully and correctly so that it can be transferred to the correct tax office and the tax account and type of tax payment. The personal income tax subsection is 1001 and the chapter is the 557 or 757, which is for the tax department or the tax office at district level. So in summary, an individual taxpayer should understand the following for his annual personal income tax finalization in Vietnam. First one is the tax resident status, which can be changed in the last year of his stay in Vietnam if he is living in Vietnam. And he needs to understand if he is not required for the tax finalization, or he can authorize to the current employer, or he has to do a self-PAT finalization. He needs to understand the tax year, due date of the tax submission, and the tax payment to ensure there's no penalty or interest or due to the late payment. Data collection, and the lastly is the tax filing timely. Now, Ms. Betty, we have some sharings on the application of the double taxation avoidance in personal income tax between Vietnam and other countries. Hi, Betty.
Hi. Good morning, everyone.
So I will start my sharing, Betty.
Yeah. Okay, I think I hope everybody can see my slides.
Yes, we can see them.
Right. So my cover is about double taxation, and I think these DTA or double taxation and the treaties are actually quite a complicated matters for many expatriates, especially when they have a dual income. As I understand from many years working in Vietnam, many expats, they will have a compensation split between the countries where they come from, and also the compensation and the salaries that they get in Vietnam. So, and many of the back-end office may not understand how to handle this double taxation or even understand what is this double taxation. So actually a double taxation agreement, or as we call it the treaties, is actually to avoid to mitigate the possibility of an employee having to subject to a double tax on the same kind of an income. So exactly what is a double taxation? A double taxation is levying the levy on the tax on the same income by two or more jurisdictions. For example, like using back the example of Tracy, she has Mr. Henry that is working in Singapore and also in Vietnam. So you have two jurisdictions, Singapore and Vietnam. So if by withdrawing salaries in both countries, or because one country is subject to a worldwide tax when you are a tax resident, then you will be subject to a double tax. So a double taxation agreement or the double taxation treaties is actually to mitigate such double liability of taxation imposed by different government in different jurisdictions on the same amount of income. So let's look at how can we mitigate this situation of a double tax liabilities. Usually in a double tax liabilities, it can be mitigated in a number of ways, such as one, the foreign source of income is actually exempted from the tax of where you are a tax resident. So it depends on which country and which is the country's regulation, tax regulation at a time in treating the offshore income. Or another case would be to exempt the foreign source of income from tax if it has already been paid the taxes on another jurisdiction that is, that is probably a higher tax if you are in a lower tax kind of a jurisdiction. So of course, this excludes tax haven. Tax haven are countries where they do not impose any tax or you do not need to pay any taxes. Okay. Or some kind of a scenario to mitigate such a double liability would be a full tax on a foreign source income, but then you can use that tax paid as a tax credit to come back like a discount if you need to declare it in the countries where you are a tax resident. So these are some of the situations where we can actually mitigate a double tax liabilities. Now, what exactly is a double taxation agreement and how government in different countries use it? So I know that by talking to different people, many people, they are aware of the double taxation agreement existence. They kind of know what they are, but they don't really understand how government in different jurisdictions who come into the agreement with the double taxation agreement use it. So different jurisdictions or different countries will enter into a tax treaties with another country. Say, for example, Singapore and Vietnam. They have an agreement together between Singapore government and Vietnam government for a double taxation agreement. And this agreement, or what is called these treaties, it sets up the rules to avoid double taxation by individual or corporate on the income that they earn, probably the same type of income. So this kind of a treaties, usually in this kind of an agreement, they have terms and conditions that include such as, for example, the both government, they exchange informations, and this is actually to prevent tax evasion, because they don't want, with technology these days, with virtual banking, with online banking, with many of these modern platform information technology, people may be living in one country and getting income in another country that is actually lower tax. So double taxation agreement helps the two governments to actually share information to prevent any tax evasion, such as a person claim a tax exemption in one country on the basis that he or she is not a tax resident in that country. But then that person does not even declare the income as a foreign income in the country where he is a tax resident. So this is something that a double taxation agreement takes care of and governs of. Or a person who try to claim a local tax relief on a foreign tax deduction exhaust that actually it had not even happened. So with a double taxation agreement, they set up the rules and terms and conditions for two governments to share information. And this also to prevent the employee having to pay taxes in two countries on the same income. Now, what are the usual issues with in applying and the complications in applying the DTA? So usually from our experience in assisting clients in applying the DTA is that when they try to apply a tax credit, usually they would have to advance tax first. Say, for example, I give you a scenarios. Vietnam is, let's say, a person who gets an income in Vietnam and a person who gets also an income in Malaysia, let's say. Malaysia is on a territorial scope of tax. That is, whatever you earn in Malaysia, you pay tax in Malaysia. Whatever you earn outside Malaysia, you're not obliged to pay tax in Malaysia. For a Vietnam tax scope is actually on a worldwide tax if you are a tax resident in Vietnam, which was covered by Tracy's slides in the different scenarios where you can become a tax resident in Vietnam. So once you become a tax resident in Vietnam, whatever income that you earn in Vietnam or outside Vietnam, whether you remit this income into Vietnam, you are obliged to report this income to Vietnamese tax government and pay the taxes in Vietnam. So let's look at this example of a person who earns an income in Malaysia, but is residing in Vietnam. And so he is actually a tax resident in Vietnam. So being a tax resident in Vietnam, whatever that he earns in Malaysia, he will also have to pay tax in Vietnam. However, the amount of money that he paid tax in Malaysia, he will become a non-tax resident and he would have to also pay a withholding tax in Malaysia. So how can he actually avoid this double taxation kind of a scenarios, right? Now, most of the time, many people would think that because I already pay tax in Malaysia, I just have to deduct that taxes that I paid in Malaysia when I declare to the Vietnam tax authorities. Usually in a double taxation treaties or a double taxation agreement, it does not really go in such a straightforward way. Usually the government in both countries will want you to pay the taxes first, and then you claim back the taxes as a tax credit later. So for example, the person who may have earned the income in Malaysia and pay tax in Malaysia as a non-tax resident, because he is a tax resident in Vietnam, he will have to declare that portion of the Malaysian income to Vietnamese government and pay the taxes in Vietnam. And while the payment of that Malaysian portion of income already has a tax paid in Malaysia, it is to apply a tax credit. But to get the tax credit, there is always a deep process and the procedures to comply, such as Malaysian authorities will want for you to fill out a certain number of forms. We want you to clarify that you are not a resident here, you are a tax resident in the country that you're trying to claim a tax credit. And you will need to have governments of different departments to sign and confirm your position before you are allowed or issued a tax credit certificate. So these are some of the complications and issues, example that we have already been through with clients in our experience when they try to apply DTA. Now, DTA is a very complicated issue. So usually we do look into case-by-case basis because it depends on which country. If the country do have a double taxation agreement or treaty signed between two countries, and what are the incomes for? Is it individual? Is it corporate? Is it a mixture? What kind of benefits? So we do look into many things into consideration. Let's look at how a client's regional corporate services covering in the presence of 10 countries in Asia who can help. So a client we can help in handling the taxes, especially for complicated cases on the personal income tax submission. Some clients, for example, they may have a offshore income. We have done this in quite many cases where the chief rep or the legal representative who are an expat who has income in overseas, they didn't know they have to declare in Vietnam. And suddenly they get this letter of notification from the tax authority confirming that they are aware that they have income in overseas and things like that. So they have to go back and do a self-declaration. So we can help to compute and try to cover this kind of complicated scenarios by backdating the submission to the authorities. We also can help the client to look into if there is any amendment needed or if there's any errors in the submission, or recompute the personal income tax finalization, because there are other ad hoc income and there are some other ad hoc income which may not be so straightforward in the question as to whether this is subject to tax or not, such as if you have ESOS, if you have pension that you paid in overseas, if you have shares in the companies, or you have some benefits that is provided by the company and you're not sure whether these benefits in kind are taxable income or not a taxable income. So a client actually performs a end-to-end kind of a service from HR, from payroll, accounting, tax, and we have all our consultants in different departments who are well-versed in taxes and covering also the region. So I finished my DTA slides. So now it's Q&A, and thank you very much.
Thank you, Betty, and thank you, Tracy, as well. These are the contact details. We'll share them across with everyone. You can stop your screen sharing, Betty.
Okay.
Really interesting information. To be fair, these elements that you shared related to the DTA, they're really technical, and not a lot of foreign individuals really pay attention to them in that respect. They kind of assume that the company will do the finalization for me and that is it. And later on, 2, 3, 5 years down the line, this type of issues may appear. So it's interesting and it's important for everyone to be aware of these things. And if they have multiple incomes, if they're looking to have onshore, offshore revenue structure individually or on a corporate level, it's always good to speak with someone beforehand to have a full understanding on how these work. As Betty said, it's not as complicated. It's not as easy as just discounting whatever you paid offshore. It doesn't work as easy as you would assume. The processes can be actually quite lengthy and quite complicated, but in the end, they can be also very useful and beneficial for your statutory position in country. So thank you again both for sharing these practical insights. We're actually right on time. We have up to 20 minutes for the Q&A. So I'd like to invite everyone to share any questions they may have for the panelists, and we'll get to them one by one. So please use the Q&A function. And let's see what everyone asked until now. We already have, I think, 3 or 4 questions. Right, let's look at the first one from anonymous attendee. If I'm a tax resident in Vietnam and I get a dividend paid from a company in Singapore, 100% owned by me, how do I declare this income, and what are the personal income tax rates for this income? Would like to take this question?
Tracy, you want to take this question?
Hi, Betty. From this question, I understand that this person received a dividend paid from Singapore, so it's not required, it's not considered an employment income in Vietnam as per the Vietnam tax law. So it's not included in the tax finalization in Vietnam.
Also, I think it depends on, you know, because you are residing in Vietnam and you're a tax resident in Vietnam, you get a dividend paid from a company from Singapore, and you are getting this into Vietnam. You know, so this dividend, depending on if you declare also this dividend paid, because I understand that when a company paid out a dividend, you sometimes you have to you withhold certain amount of taxes in the country where you paid the amount of taxes. So we need to look into more of a scenario. So of course, on the on-site, on a general side, okay, a dividend paid a dividend that you receive an amount from Singapore, if you already paid the taxes in Singapore, you may not need to declare this into the PIT fund because it's not considered your regular income in Vietnam. So also depends on what are your income status in Vietnam and what is your visa status in Vietnam. So in Vietnam, it's not as straightforward as Malaysia and Singapore, because we look into what is how do you categorize yourself? What is the status of you living in Vietnam? Are you living under a spouse visa, or are you living under work permit, or a tourist, or a business visa? So all of these categorization, you know, will decide the status of your tax on what you need to do with your declaration of income. Okay.
Thank you, Betty. One more question. The dependent relief only counts for dependents based in Vietnam, or a father of a foreigner who lives in another country, not in Vietnam, could also be counted as a dependent, and then you can apply for dependent relief as well on your PIT.
Yeah, the dependent can live in Vietnam or live overseas if they meet the condition for a tax dependent.
So in short, it's like, let's say, for example, in this example, you have a father who is not living in Vietnam. This person is probably living in Vietnam who wants to claim the father or the, you know, as a dependent. As long as you can prove that is your father by showing a birth certificate, you know, his passport, and probably he's not working, you know, so then you probably will be able to claim him as a dependent, even though he is not living in Vietnam. So usually what we do is we request supporting documentations from clients, and we vouch it through. And we will tell the client first that if there's any problems with the documents, or this is going to be a straightforward information and documents to be submitted to the tax for approval.
Thank you, Betty. One more question from Andrea, and this one is related as well to worldwide income. So maybe we can clarify a bit more here about worldwide income for foreign individuals with a tax resident in Vietnam. Any income that is earned worldwide has to be declared, or only the one related to employment income? For example, profits from being a shareholder in a foreign company, are they taxable in Vietnam?
Yeah, a worldwide income means whatever you earn outside Vietnam that is under the taxable income in Vietnam, then you have to declare in Vietnam. So, for example, if you say you earn profits from a company that is outside Vietnam, now, what do you mean by profits? Do you take dividends out and you put it into your foreign bank account, or you actually take you actually withdraw from that offshore company that, I mean, I'm talking about offshore because it's outside Vietnam. So do you take do you withdraw the funds out from that offshore company as a salary or as an allowance, you know? So the way that the money is being withdrawn, or the funds is being withdrawn from a company to yourself, then of course it is considered your own income. Now, I have also many clients who ask me, in a situation where they say, Betty, I own 2 companies in outside Vietnam, and these 2 companies are making profit. My next question to these clients would be, did you take out this profits for yourself, or you kept it in the company? Of course, if the profit is kept in the company is a separate entity from your individual self. So as long as you do not withdraw it for your own self as a dividend, or as an income, or as an allowance, or as a salary, or as a director fee, you know, you kept the company in the company, you do not need to declare this profit to the Vietnamese government, because it is held by an entity in the offshore status, even though you are a full beneficiary or owner of this company in offshore. But you, as long as you don't withdraw the funds out to yourself, to your personal bank account, you don't have to declare that. So hopefully that answers that question.
Thank you, Betty. We have a couple of more questions, actually. If a foreigner just came to Vietnam for 1 week, but they have a signed lease for an apartment for 183 days, is the foreigner considered a resident in Vietnam?
Yes, for these questions, the tax authority will base on the current documents, any documents that which can be based on that to evaluate the tax resident or non-tax resident. So based on the lease contract that they sign, this person is assumed as a tax resident in Vietnam.
The rule of thumb is that the tax authority in Vietnam, they love to put you as a tax resident. So they put it as an or situation.
They will base on any supporting documents or any documents that they use that as a condition to assess the person that is a tax resident.
Yes. So that's why even if you're, I mean, 1 week it's good, but even if you just step into Vietnam, and before you step into Vietnam, you already have an apartment leasing, like an agreement for a year. Let's say you sign the apartment with the landlord for 2 years because you want to fix the rental. Unfortunately, even you just step into Vietnam, you're already a tax resident. So just be careful. So usually our advice to client is that if you are an expat, or you are a Vietnamese, you know, who are from overseas and you want to come back to Vietnam or whatsoever, you know, visit relatives or to work or to do business, okay, we always tell the client, do plan your tax position in Vietnam, because it is not a full. We do have clients that they get paid in dual countries and things like, because you know, different countries are sharing different information and you don't know what they're sharing. They may serve you a letter to say that we are aware that you get this income in overseas, and at the time, it is too late to even plan anything. So our advice to clients is usually plan. Before you step into the country, before you try to draw down the first salary or the first fee or the first profits in Vietnam, is about planning.
Thanks, Betty. One more question on letter of authorization for the PIT. Can they allow employees to sign online, add their signature online instead of signing directly on paper for the letter of authorization for the finalization?
Yeah, for these questions, we have to confirm that the employees need to sign directly on the paper, because in Vietnam, all the procedure is paper oriented. So the tax office will base on the physical signature rather than the online signature.
Unfortunately, no matter how much digitalization that the Vietnamese government want to do it or want to achieve, it is still a developing countries. They are, so the government are very wary about receiving anything that is digitally signed, because this can be forged very easily, and they are very professional out there who are very good in this document forgery. So that's why the government always rely on manual printing of that paper, printing of the forms, getting your signature. Even if you sign, usually, we will advise the client to sign with blue pen, because if you sign with black pen, and you send in, so the government actually prefers the signing is with a different color of pen, that is blue pen usually.
Thank you, Betty. One more question from you. Is there a dividend tax in Vietnam for paying dividends to shareholders residing in Singapore? So I think this refers to if you pay out dividends from a company in Vietnam to shareholders in Singapore, is there a dividend tax there?
Yeah, I think there is a dividend payment out from Vietnam, okay, a Vietnam entity. You have two types of payment. One is that dividend paid to another entity. So entity A pays dividend to another entity B. This is no tax because it's entity to entity. If the dividend is paid out from an entity to an individual, it doesn't matter where this individual is. It can be in Vietnam, it can be in overseas, right? It is subject to a flat rate. If I'm not mistaken, it would be, I think, 5%.
That's correct, yes. So tax on dividend payment to individuals, 5%, tax on dividend payment to corporates, 0.
Yes. Now, the tax to the corporate is 0 because they assume that when another corporate will receive the dividend, it will be regarded as their income, and this will be included into the corporation tax.
One more question, also looking at entities and individuals in Vietnam. Foreign individual lives in Vietnam for quite a long time. He has a company registered. What is the better way to claim the tax for the company and for the individual? Make a contract and pay monthly, or pay per project?
Okay. So this honestly is a very generic question. There are many ways on how you want to claim the tax on the company. And obviously, if you leave the profits in the company, you pay a 20% of tax. So, now, of course, if you want to withdraw the funds out and you make it as your personal payment, whether, if you declare it as a salary, then of course you will have all the SMUI contribution, all these union and things like that. All right. And personal income tax based on progressive rate, right? So there's always like a balance in the scale. If you live in a company, you're going to pay 20% of tax. But if you take it out as a personal and you're going to subject to yourself as a progressive tax, and you're going to end up paying 35% of tax, then obviously, without even knowing the detail, I say live in a company and pay 20% of tax. You save 15% of tax, right? Okay. But of course, if you say that, pay per project. Now, again, when you pay per project, you can always it's up to you. Like you can always pay per project by getting, relevant and supporting documentation, subject yourself to a 10% tax. However, when it comes to tax inspection, this is always the issue. Will the tax authorities who will inspect the companies, agree that all of this payment goes out to a freelancer by a project? If they do not agree this, they're going to end up adding these deductions, these expenses out, and you're going to end up paying 20% of tax. So let's say, for example, you say, okay, I don't want to pay a personal income tax. I don't want to pay progressive tax rate. I don't want to pay SMUI and things like that. So you pay yourself as a freelancer in a project and you deduct 10% withholding tax, okay? Now, after 2 years and 3 years, because they won't come immediately, they come, they do the tax inspection. They say, I don't agree with this deduction of that project contract. I add it back, okay? And when they add back these expenses, you have to pay 20%. So you actually end up paying 10% withholding tax, 20% of the corporation tax, 30%. So, all of this question, there is no a right and a wrong answer, but we need to, that's why we call it tax optimization and tax planning. A tax optimization and tax planning is a very complicated topic. We need to look into different aspects. What does the company do? What are the project? What kind of scale? How many transactions you have in a year? For us to actually come in and advise the client what would be the best combination of all.
Right. So we have now we reached the last part of this webinar and discussion with a wrap-up question for both Betty and Feng to kind of bring together the entire topic and really try to structure the most important elements from your side for the international individuals that are working and residing in Vietnam and how to plan their personal income tax finalization. So Betty and Feng, from your experience of working with clients for the last 5, 10, 15 years, what is the most important thing that individuals should know in regards to personal income tax finalization? Looking at that practical element that you think is important. So we can have one closing.
You give your advice.
Excuse me. I didn't focus on the question. Can you say again, Betty? Blank.
Yes. So I was saying, based on your practical experience with clients, what is your key advice looking at personal income tax finalization for individuals in Vietnam? What should they pay attention to most? What is that key element that is very important in your perspective?
Yeah, for a foreigner stay in Vietnam, if he's a resident in Vietnam, so he needs to do the tax finalization. So he may consider the tax dependent if he can register any non-taxable benefit that he can apply in the labor contract, and he needs to plan any non-taxable benefit. He needs to plan his stay in Vietnam, or he needs to understand if he has any other service contract, such as the consulting fee, management consulting fee, if he receives from other companies when he stay in Vietnam.
Tracy, continue.
Social income may be included in the tax finalization, or can be chosen to remove from the tax finalization. So we need to understand that income.
I think I can add on as well that the key is planning. Anything that comes to tax, today we're talking about personal income tax. Any taxes that you're handling is all about pre-planning. So plan. That is our key advice to you. Okay, whether you are an expat or you are a Vietnamese who are currently holding a position in a company, or you're looking to change a position in into a new company, is always to plan and plan, because taxes it comes with also the duration, the timing, the time frame, the types of income, where you're working, you know, there's a lot of aspects of it. So it is not a mere of like, okay, you know, I want to do this and I think this is the right thing, let's do it tomorrow. You know, you may not get that effect or that results that you wanted it, you know, without a pre-planning. So obviously, I think the very important word here for a personal income tax, you know, is planning.
Thank you, Betty, and thank you, Tracy, as well, for your practical insights and also very technical elements that you shared on the DTAs, on documentation that needed for the PIT. This concludes our webinar for today. And I would like to thank as well the attendees for their participation. Thank you again to the panelists for sharing the information with us, and keep in touch with us on our LinkedIn channels, on our website. We often post relevant information that is important for investors and individuals about their taxation and about how they can use various tools to optimize their taxation as well. We're going to share, as I said, this recording with all of you by email and on our YouTube channel. So please follow us on YouTube, just to keep it easier. And again, thank you for your attendance. Wishing everyone a good end of the day. And let's keep in touch for our next webinar. Thank you, everyone.
Thank you, everyone. Yes, thank you. Bye-bye.
Thank you, everyone.
Bye-bye.
Thank you, Celeste.
Bye.
Bye-bye.